All right, it's time to get started. Hey, everybody, I'm Chuck Vosburgh from NextHome Gulf to Bay, and I work with my wife, Pat. We're a husband and wife real estate team. We've been seeing a lot of problems with people lately. People literally in tears that are either trapped in renting or maybe they're out there trying to get a house and, they've got a mortgage, but they aren't able to win a house because cash buyers keep beating them out. So these are the two categories of people that are really struggling right now. And we figured we've got to find a solution to this. And fortunately, there is a solution. There's a plan of action. There's something you can do, especially if you're not quite mortgage ready. So let's kind of back it up a little bit and let's take a look at some of the statistics. Rents are up 24% around here over this time last year. The value of property is up 24.7% compared to this time last year in this area. And I don't think anybody's income is going up 24%. So that gives us what we call an affordability gap. Every month that goes by, the gap is getting a little bit bigger. And that presents a big problem because as time goes by, that house gets more and more out of reach for everybody. So that presents a big problem. And there's a lot of reasons why somebody might not be able to get a mortgage or get really great terms on a mortgage. Maybe their credit score isn't quite up to par just yet. We're just coming out of the pandemic. A lot of people took financial hits during that time, and it's really hurt a lot of people. So maybe your credit score isn't as high as you'd like it to be. You may have a bankruptcy in the past, or that's something that would prevent you from being able to get a traditional mortgage. If you changed jobs recently, and which encompasses a lot of people, again, because of COVID, we've got so many people who don't have 2 years of work history that they can verify. So then that puts them out from a mortgage. And then there's all the people who are self-employed or independent contractors or gig workers, people who don't have a traditional 9 to 5 kind of employment. So that cuts out a huge amount of people, and those people become trapped. And therein lies the problem. And the problem is that the banks are not motivated to adapt and to help people in this more modern economy. They don't have a good reason to. And first of all, they want to have zero risk. That's one thing the banks want. They've got enough people out there, evidently, that they can loan money to that and have zero or darn near zero risk. And that way, it's enough to keep them going. So they're not serving this huge, huge population that fits all the categories that I just mentioned. And the whole system is designed for the old days. In the old days, they'd get a job at a company and they'd stay there for many, many years. And in fact, in many cases, they'd stay there until it was time to retire. So that's how the financial system is designed to work. It's designed for people who are going to go get a permanent full-time job at a good company, and they're just going to stay there. Well, there's no such thing as permanent full-time employment anymore. It's a thing of the past. So the system is damaged in that way, and banks don't have any motivation to innovate because they're making plenty of money, evidently. And I think it's kind of self-evident that they are. So we've got that. And of course, if we can't wait on the government to help because they're not going to. They haven't done anything about this. They keep talking about it. But we can't count on them either. We're going to have to count on ourselves and a plan. So before we kind of get into this plan, I got to tell you, Pat and I were very, very skeptical in the beginning because there's been a lot of programs in the past. There's ones, rent-back programs were real popular, and we actually researched that too because it kind of sounds like a good deal on the surface. But then we found out that even with the largest and most popular rent-back company, that buys a property and then rents it back to you and you can buy it from them later, only 7% of the people actually ended up owning the house at the end of it. And so we were thinking, well, if only 7% of people end up owning the house, that's not a success at all. Those people are still trapped in renting. So that's not a solution, and we definitely don't want anything to do with that. Pat and I have made our life's work getting people into houses and of course, helping people sell their houses when it's time to move. So, there had to be a better way. And then we ran across one of our colleagues introduced us to this program that I'm going to explain to you now. So we decided to get involved in it for a couple of reasons. We've got this motto that's called Humans Over Houses, and it's not just a marketing thing. It's really how Pat and I live our life. We really believe in putting people first. And I think anybody that knows us personally will verify that. And when you read our testimonials, you'll see that over and over again, that we really have a heart for service and we have a heart for helping people. And so we got these buyers, we got problems with people renting and the rents are going up faster than their income. People are actually, they're having to downsize, they're having to move back with their parents, they're having to, squeeze into accommodations with friends. Families are getting displaced. It's truly a crisis. So if you're a renter and you don't work for a full-time with a company and you've been there for many years, you're kind of left out in the cold. So you need a plan. So I want to show you some slides here that kind of lay this thing out so that you can understand it. And then I'll answer lots of questions at the end. I know some of you got questions already, and I'll answer them right after that. We're almost done with the explanation part. So I'm going to share my screen here. Hang on just a second. Okay, great. So I'm taking a look at my slides here. And first, I'd like you to meet Adina. Adina moved here from another country when she was a teen. Her parents and her and the rest of the family, they moved here from over in the Middle East. So they moved here, and even though both of her parents had very good jobs, they were technical people, they couldn't get a mortgage. They couldn't get into a house. And she saw growing up how difficult it was for people like her parents who were very skilled people. They earned good money, but they were the kind of people that worked on contracts. They were technical workers. They'd go, they'd do a job, and then they'd go on to the next job, and so forth. A lot of people work that way. But it was a problem. They couldn't get into a house. And that's one of the reasons they moved here. That's the American dream, is to be prosperous and own your own house. And so she saw how frustrating it was for her family. And when she grew up, she grew up to be a technical person too. And she had an idea. And she started a program. So here's how it works. First of all, I want to kind of go over what the qualifications are, because obviously it's not for everybody. But the entry to get into this is very easy. You have to have at least a 550 credit score. Your household income needs to be at least $40,000 a year so that you can afford a house. You have to have a steady income source. Now, that income source is steady, means 3 months. And they don't care where it comes from. As long as you've got at least 3 months worth of verifiable income coming into your bank account, you can qualify for this, because they know that most people are self-employed or they don't have permanent full-time employment. They just need to know that you're able to earn money. So steady income source equals able to earn money. Your debt to income ratio can't be more than 50%, including your home payment, because they don't want you to get into a situation where you're setting yourself up to fail. No evictions in the last year, no bankruptcies in the last year, and you have to have 2% of whatever the value is of the property that you're going to get, plus your first month's payment. And all that math that'll all get laid out and figured out for you automatically. It's only for single-family homes. It doesn't work for condominiums or townhomes. It has to be a regular house. The house has to be in good condition. It's got to be safe and move-in ready. Can't be any kind of fixer-uppers or anything like that. They want you to be able to move into a house that's safe and good and something you're going to be very happy with and not have to be putting money into it and fixing it up. They don't want any homeowner associations either. Homeowner associations are kind of problematic. Some neighborhoods have them where there's an association, and those are the kind where they got the rules where everybody has to have a certain mailbox, or if some of your yard's not quite green enough, they'll fine you. They don't want to get involved in any of that, and they don't want you to get under that either. And they'd rather it not be in a flood zone either, because if you're in a flood zone, then you have to pay flood insurance, and flood insurance can be kind of expensive. So if you're in an area that floods, they'd rather you didn't. It's not a hard, fast rule, but they'd rather you didn't buy in a place where it's likely to flood. So here's how it works. You go online and you sign up, and you just fill out a few questions. It takes about 5 minutes. There's no fee for it, no cost involved, and it's not going to affect your credit either. They're not going to do a hard credit check or anything like that. You just fill out some questions, and almost instantly, they're going to tell you what you can qualify for. And then once you're qualified, if there's another person that you'd like to put on it, then you can add the other person at that point, and they'll refigure it and see what it would be with both of you on it. So you'll find out what your budget's going to be. And that's where Pat and I come in, because then it's time to go house hunting. So we go looking for a house just like you would with any other realtor, and we go looking for houses. And you may be wondering, how Pat and I get paid. Well, there's nothing in it for us for this program that I'm describing to you. They don't pay us. There's no commissions. There's nothing involved in that. The way we get paid is when a person puts a house on the market, they offer a certain commission to be paid to whoever the buyer's agent is. So that would be us. We're your buyer's agent. So whoever brings the buyer and takes care of their side of the transaction, the seller pays whatever the offer is. There's no set number. It's just, they'll put on there what the offer is, and we don't really consider what that offer is because it's unethical to make decisions based on that. Of course, we have to put the customers first and not put our own self in front of you. So that's how we get paid. So we go house hunting. You can go on the website or on the app, and there's a map. You can check out houses. Pat and I will be helping you look for houses too. We'll be sending you houses. You're going to be looking online, and we'll be working together to find the perfect house. So once you find a house, then all the numbers are all broken down for you. So they tell you exactly what you're going to be dealing with as far as the purchase price and what your monthly is going to be, and I'll explain the rest of it as we go. So here's an example that I pulled up. So this house was listed at $399,988. So you can see here, okay, so that's going to equate to $3,110 a month for this house. As we scroll down, I know this is probably going to be impossible to see on the webinar, but we got the monthly. We've got an option here because you're going to have different options. And then if you're going to buy the house back from them before 18 months, this is what the price would be. And if you wait for the full 3 month, it's limited to 3 years. If you wait 3 years, then it'll be this. Now here's where it gets interesting, because the increase in price in the house is predetermined, and it's predetermined at a rate that is capped at 7%. So they're not going to increase the price of the house any more than 7% a year. Now keep in mind, the price of houses right now is going up at 24% a year. So what's going to happen is you're going to get instant equity when you get to the end of this. So you're actually building up equity during the time that you're leasing the house from them. So they pay cash, and you lease it back maximum of 3 years. You can do it less if you want. They lay out everything in advance so you know what's going to happen. And they give you some different options too. It's going to be based on your particular financial situation. There's not a set way they do this. But this is how you beat inflation. This is how you beat rising home prices, because everything gets locked in. It never goes up. It's going to be exactly what they say and what you agree to. So that beats inflation. That's how you get wealth, is by building equity in your property. Now, here's the thing I want to explain to you, though. This is the genius of it. I mentioned to you before that with the rent-back programs that are out there, only 7% of people actually end up buying, and which is a giant failure, in my opinion. And there's different options, but typically a 25% savings into this. So they're actually taking 25% of your monthly payment, putting it into a savings account, so that at the end of the term, you've got plenty of money for your down payment. Because they found out that more than 70% of people who were not able to buy their house, the reason was because they didn't have enough for the down payment. So this way, you're guaranteed to have the money. So when you get to the end of it, you've got the money. And people always ask, in fact, the question just came up, what happens if you don't want the house at the end? Well, you just take your savings and you can go buy something else. And it's all laid out in advance. Everything is, I think it's a really fair deal. But, if you're like most people, you're like, okay, so how does this compare to what if I could get a traditional mortgage? So I did some math here. So using this same example, I had to make some assumptions when I was doing the math. So I assumed that someone had a credit score of around, between 700 but not quite 720. And that the interest rate was going to be a little over 5%, because when I sat down and did that, that's what the prevailing rate was. So first of all, for this house, to get a mortgage, you're going to need a 5% down payment. Now, I know there are exceptions to that, but generally speaking, it's going to be 5% down, which means you need $20,000. You also need to have closing costs. There are taxes involved. There are other fees and expenses involved when you're getting a mortgage. Those in this case would amount to $4,774. So what you would need to bring to closing is $23,997. Now, that's a chunk of money by most people's standards, and that's why most people aren't able to go with the traditional mortgage route right now. So with this, your total monthly payment, it'd be $2,743, and then there's some other costs involved. So you're right at $3,000 a month if you're doing a regular mortgage. So over here, if you go with the program, they give you a couple different examples here, different ways you can approach it. So in this case, you've got an $8,000 down payment. That's 2% instead of 5%. So instead of a dollar short of $20,000, it's $8,000. In this example, they're going to be putting 5% every month into a savings account. So your lease payment is $2,725, and $385 is going to go into the savings account. So at the end of it, you're going to have $24,653 in the bank so that you can go out and get a mortgage and purchase that house. And then if you don't, that's okay too. They have a way where you can just get your money back, and that's fine. So you can see it's comparable. It's about the same money as if you were getting a traditional mortgage, but you get a lot of benefits. So let's talk about the purchase price. So I did this example here, and they figured out it was 6.66% is what they capped the increase at. So their absolute cap is 7, so this came in just a little bit under. So over 18 months, the value of that property is going to go up $45,000. Over 36 months, which is 3 years, $90,000. Now keep in mind, let's just say the market takes a real big dip and it becomes half of what it is right now. So I did these numbers on 14% market appreciation. Keep in mind, when I did this, it was 27.9%. So what you're going to end up with is $38,988 worth of equity in your house. Or if you go the 3 years, you're going to end up with $77,977 of equity. So I know I'm laying a lot of math on you right now, but my point of all this is, and this was Pat and my concern when we got involved with this, is that it has to be a fair deal. And we believe it is. It is a good, fair deal. And these numbers kind of prove that. So here's how it works. So you're thinking, okay, yeah, it sounds good. How does the whole process work? So we go out, we find the perfect house. And we tell Divvy, okay, we're going to make an offer on this house, and you're going to make a $500 initial deposit. You're going to sign the agreement saying that, just agreeing to all the numbers that they laid out for you. And then they're going to buy the house for cash. They're going to make an offer. Pat and I will negotiate the offer, get the best deal we can. And they're going to offer to buy the house for cash. And you know as well as I do, cash is king. So when it comes to purchasing a house, a cash offer almost always wins. So once the seller agrees to it, then they're going to send an inspector and inspect the house. If there's anything that needs to be fixed, they'll make a list and we'll negotiate that with the seller. And when it comes time to, get that thing ready to close, you pay your 2% down payment and your first month worth of lease. The closing will happen, and Pat and I hand you your keys. So it's really a very simple process. And the good news is there's no extra costs involved. There's no taxes, there's no fees, there's no having to pay for the inspector. It's all taken care of. Now, if you want to check this out, and I'd encourage you to do it because it doesn't cost anything, and the only way to see how your numbers are going to lay out is to go in, spend 5 minutes, and fill out the little form so that they can figure out what your particular situation would be. I'd say it's worth 5 minutes to start building wealth for you and your family. So it takes about 5 minutes. Once you're pre-approved, we can go shopping and we can go find the perfect house. They're going to ask you for some documents, some copies of your bank account, stuff like that, just like you would expect. So those are the things that are going to happen. It's a really simple process. We think it's a really great idea, and I would highly encourage you to do this. So this is by invitation only. So I'm going to send you a link where you can sign up. So I'll email that to you just as soon as we're finished here. And click that link, go sign up. Now it's time for questions and answers, and I will be happy to tell you anything you want to know. So one of the questions that came up is, what happens if your needs change? Like you don't like the house anymore or you need something else at the end. So let's just say, for example, you get to the end of the 3-year term and maybe your needs have changed. That house isn't quite right for you anymore. Well, what they're going to do is they're going to give you your savings account back. And they're going to hold back 2% of it because they're going to have to paint the house and get the whole thing ready to sell. So you get all your money back minus just 2%. So that's what happens if you decide you don't want the house. This is a good question, just came up. What happens if the market collapses? And that's a good question. People always ask me that. And that's another thing where I think this is a good thing because it's kind of a hedge against market collapse, because if you, like, let's say, you get to the end of it and the market has collapsed and you're like, I don't want to buy this house at that price. Well, one of two things can happen. You can either negotiate a new price with the folks, and which they'd be stupid not to do because they don't want to get stuck with a property. They're not in the business of holding properties and trying to sell them. Or you can just take your savings money and go buy something else out there that, assumably if the market were to crash, you'd be able to find some cheap properties, and so you could go out and buy something else. So it's a really good hedge against that. Oh, does it? Do you get a ding on your credit when you sign up? No, you don't. They do. At first, there's not a credit check at all. They're just looking at the information you provide. And then at some point during the process to get fully approved, they're going to do a soft credit check. And what that means is it's a kind of credit check that does not influence your credit score. Because the credit companies, they kind of came to realize that when people are going to get a loan, maybe they're going to buy a car or get a mortgage or whatever, they're going to do something financially. They want to shop around to get the best deal. So they stopped doing a ding on the credit every time somebody does an inquiry. So that's called a soft inquiry. So that's what they do. And that way you don't have any problems with your credit score getting harmed by the inquiry. So I hope that made sense. Kind of felt like I rambled on that one. Oh, yes. If you've had an eviction or a bankruptcy in the past year, then you will not qualify for the program. But I think that's pretty good, because most people, especially with bankruptcies, if you have a bankruptcy, that follows you for a long time. So this thing, if it's just a year, if your bankruptcy is a year behind you, you're good to go, because they just want to get you in a house. It doesn't really matter to them, because they're using a whole new business model that the banks have no interest in doing for some reason. How do you sign up? I'm going to email you a link, because I want you to be able to sign up. You'll just click the link and you just go right on there. It's right online. It takes about 5 minutes. All right. Well, I don't see any other questions. If you do have any other questions, email me, give me a call, or give Pat a call. We'll tell you anything you want to know. No strings attached, no pressure. Like I said, we put humans over houses. So thank you so much for watching. I really appreciate you coming tonight and spending your time. I know I gave you a ton of information really fast. So if you got questions, and I'm sure you do, just give me a call or email me or text. We'll tell you anything you want to know. So thanks again, and here's looking forward to you with your home ownership dream and starting to build wealth.